Well, hello everyone, and welcome to the IMF. We are delighted that you could join us today for this online discussion. I'm Jerry Rice, Communication Director here at the Fund, and I'm especially pleased to welcome you all to this discussion on new policy frameworks for a low for longer world. And it's really a pleasure again to connect with such a broad group of distinguished scholars, academics, policymakers, and colleagues around the world. The pandemic is causing unprecedented challenges for many of us, for many institutions, and notably for many leading central banks. And today, we're honored to have a very distinguished group of speakers with us. Let me introduce them. We have Carolyn Wilkins, who is the Senior Deputy Governor of the Bank of Canada, and Carolyn will be our moderator for today's discussion. I want to also introduce Richard Clarida, who is, of course, the Vice Chair of the Board of Governors of the United States Federal Reserve, and Tobias Adrian, the IMF's Financial Counselor and Director of our Monetary and Capital Markets Department. And let me mention that Tobias is, we're actually publishing today at the Fund what we think is a very important paper of his, which is called Low for Long and Risk-Taking. So right on topic for today's discussion. So the discussion is about to begin. But just before it does, we have one other very special guest that I would like to introduce to you, and that's the Managing Director of the International Monetary Fund, Kristalina Georgieva. So I want to give the floor first to Kristalina to make some opening remarks, and then we will move on to this very timely discussion today. Managing Director, over to you, please.
Thank you, Jerry. Good afternoon, Washington. Good evening, Frankfurt. And hello to everyone, whenever you are. It is my pleasure to welcome you to this policy dialogue focused on the consequences of low for longer interest rates around the world. By now, you know the story very well. Central banks have taken forceful and timely actions, providing ample liquidity and easing monetary policy. These actions have helped maintain the flow of credit and avert financial catastrophe from the COVID-19 onslaught. The work, however, is far from done. Even before COVID, central banks were struggling to boost economic activity and keep inflation at the desired level. A range of policies has been deployed, including promises to keep policy rates very low and a large-scale asset purchases. They have guided the way in the decade following the global financial crisis and spurred one of the strongest employment expansions in history. It benefited many lower-skilled and minority workers. The abrupt collapse in activity caused by COVID-19 brought unemployment back in focus and added to it the risk of skill deterioration and an increase in poverty for the first time in decades. This puts pressure on central banks to deliver more rate cuts and further policy accommodation. They do have a critical role to play in what I call the long ascent out of this crisis. The problem is that more of the same is not possible, and it will not be sufficient today. Central banks cut policy rates sharply after 2008. Nowadays, these rates have already been pushed to the floor or even below zero. Even with a very long-term government bond yields that are extremely low or negative, we have limits to the scope for government debt purchases to boost the economy. Now many central banks are going back to the lab, reviewing their frameworks to identify innovative strategies and tools that will support the recovery from this crisis and support it beyond the crisis. And we have a fantastic panel: Richard Clarida, Philip Lane, Tobias Adrian, and the moderator, Caroline Wilkins. They will discuss some of the new ways that central banks can apply to lift up stimulus to achieve their objectives and some of the trade-offs they will face. This pioneering effort will be helpful around the world. Everybody needs it. Many emerging markets now face the same challenges to boost their economies in the wake of the pandemic, with more limited room to cut interest rates. Earlier this year, we saw many of them trying asset purchases for the first time. And of course, we need these new strategies, but recognizing that new strategies and tools might produce new risks, new side effects. While new frameworks and tools may speed recovery, additional monetary stimulus may pose important risks to financial stability. We cannot take financial stability for granted. The traditional approach to deploy financial regulation and macroprudential tools to mitigate such risks is in our hands. It should still be done, but it may not be enough. As my dear colleague, our Tobias Adrian, shows in a new paper, easier financial conditions today could encourage excessive risk-taking. Monetary policy makers will need to balance a short-term boost to inflation and output against a buildup of macro-financial vulnerabilities. Tobias will explain this trade-off in his presentation. So let me conclude. Central banks must be innovative and bold, as they have been before, in reviewing their frameworks, in updating their toolkits. This will give them vital new ammunition to fight the crisis and support the recovery. But monetary policy cannot do the job alone. Fiscal policy has a significant role to play. Policymakers have stepped up fiscal support during the crisis and need to continue to do so to underpin a sustainable and inclusive recovery. We need to walk on two legs. The IMF is very supportive of these efforts. Finding the right policy tools and approaches to stimulate our economies while managing the risks is our critical endeavor. It is also consistent with our commitment to helping our members overcome the crisis, restore growth and confidence, and tackle challenges on the road to a more resilient global economy. The stakes could hardly be higher. Shielding millions of people from the tragedy of job losses and prolonged downturn is what we ought to do. And I look very much to the conversation, hearing the insights from our panelists. Enjoy it, and I can guarantee you would find this to be educational and also fun. Thank you very much for joining us here today.
Thank you very much, Kristalina. I'm going to pass the baton here to Carolyn to get the discussion going. But before I do, I had neglected to introduce Philip at the beginning, Philip Lane, whom I think we all know is the very distinguished chief economist at the European Central Bank and member of the executive board of the European Central Bank and a very good friend of the IMF. With that, Carolyn, over to you, please.
Well, thank you very much. And I'd first like to thank the managing director for her inspirational opening remarks and the warm welcome and also for the invitation to be part of this illustrious group of people today. Many of you know that the Bank of Canada is working on our own review of the monetary policy frameworks, while at the same time responding to COVID with our extended toolkits and many of our tools being deployed for the very first time. And so I personally, and I know my colleagues at the Bank of Canada are really looking forward to the discussion. And what we'll do is we'll kick it off with some remarks from each of our panelists just to set the stage before we start our discussion. And I'll start that off with Richard.
Well, thank you, Carolyn, and thank you to the organizers for inviting me to participate in this event. On August 27th, the FOMC unanimously approved a revised statement on longer-run goals, which represents a robust evolution of our monetary policy framework. At its September meeting, the committee made material changes to forward guidance to bring it into line with the new policy framework, and in so doing provided transparent outcome-based guidance linked to the economic conditions that must prevail before the committee expects to lift off from the effective lower bound. 5 features of the new framework in the September FOMC statement define how the committee will seek to achieve its price stability mandate over time, and I'll review them now. First, the committee expects to delay liftoff from the ELB until PCE inflation has risen to 2% on an annual basis, and other complementary conditions have also been met. Second, with inflation having run persistently below 2%, the committee will aim to achieve inflation moderately above 2% for some time in the service of keeping longer-term inflation expectations well anchored at the 2% goal. Third, the committee expects that appropriate monetary policy will remain accommodative for some time after the conditions to commence policy normalization have been met. Fourth, policy will aim over time to return inflation to its longer-run goal, which remains 2%, but not below once the conditions for normalization have been met. And fifth, inflation that averages 2% over time represents an ex-ante aspiration of the FOMC, but not a time-inconsistent ex-post commitment. As I highlighted last week in a speech at Brookings, I believe that a useful way to summarize the framework defined by these features is temporary price level targeting at the ELB that reverts to flexible inflation targeting once the conditions for liftoff have been reached. Just such a framework has been analyzed by, among others, Bernanke, Kiley, and Roberts, and Bernanke, who in turn build on earlier important work by Charlie Evans, Reif Schneider and John Williams, Egerton and Woodford, among others. Each of these 5 elements of the new framework is consequential, and I now discuss them in turn and provide some context for how I understand them to relate to the monetary economics literature on temporary price level targeting. A policy that delays liftoff from the ELB until a threshold for average inflation has been reached is one element of a temporary price level targeting strategy. In our September FOMC statement, we communicated that inflation reaching 2% on an annual basis is a necessary for condition for liftoff from the ELB. TPLT with such a one-year memory has been studied by Bernanke, Kiley, and Roberts. The FOMC also indicated in our September statement that the committee expects to delay liftoff until inflation is, quote, on track to moderately exceed 2% for some time. Now, what moderately and for some time mean will depend upon the initial conditions at liftoff, just as they do under other versions of temporary price level targeting. And the committee's judgment on the projected duration and magnitude of the deviation from the 2% long-run inflation goal will be communicated in the quarterly summary of economic projections for inflation. In the TPLT studies I cited earlier, policy is assumed to revert to an inertial Taylor type rule after liftoff, and therefore policy remains accommodative for some time, which depends in these formulations on the degree of policy inertia in the reaction function. Our September FOMC statement also calls for policy to remain accommodative for some time after liftoff. And once the conditions for normalization have been met, the SEP dot plot will convey the committee's projections for the pace of liftoff as well as the ultimate destination for the policy rate. Now, our new framework is asymmetric. That is, as in the above cited TPLT studies, the goal of monetary policy after liftoff from the ELB is to return inflation to its 2% longer run goal, but not to push inflation below 2%. In the case of the Federal Reserve, we've highlighted that making sure that inflation expectations remain anchored at our 2% objective is just such a consideration. Speaking for myself, I follow closely the Fed staff's index of common inflation expectations as a relevant indicator that this goal is being met. Other things equal, my desired pace of policy normalization post-liftoff to return inflation to 2% would be somewhat slower than otherwise if the CIE index at the time of liftoff is below its pre-pandemic level. Another factor I will consider in calibrating the pace of policy normalization post-liftoff is the average rate of PCE inflation since the new framework was adopted in August of 2020, a time, as it happened, that the federal funds rate was constrained at the ELB. Our framework aims ex ante for inflation to average 2% over time, but it does not make a time-inconsistent commitment to achieve ex post inflation outcomes that average 2% under any and all circumstances. The same is true for the TPLT studies that I cited earlier. In these studies, the only way in which average inflation enters the policy rule is through the timing of liftoff itself. Yet in simulations at FRB-US under TPLT that reverts to flexible inflation targeting after liftoff, inflation does average very close to 2%. The model of Mertens and John Williams delivers a similar outcome, even though the policy reaction function in their model does not incorporate an ex post makeup element. It delivers a long-run unconditional average rate of inflation equal to target by aiming for a moderate inflation overshoot away from the ELB that is calibrated to offset the inflation shortfall caused by the ELB. An important evolution in our new framework is that the committee now defines maximum employment as the highest level of employment that does not generate sustained pressures that put the price stability mandate at risk. As a practical matter, this means to me that when the unemployment rate is elevated relative to my SEP projection of its long-run neutral level, monetary policy should, as before, continue to be calibrated to eliminate such employment shortfalls, so long as doing so does not put price stability at risk. Indeed, in our September FOMC statement, we indicated that we expect it will be appropriate to keep the funds rate in the current range until inflation has reached 2% and labor market conditions have reached levels consistent with our assessment of maximum employment. In our new framework, when in a business cycle expansion, labor market indicators return to a range that in the committee's judgment is broadly consistent with this maximum employment mandate, it will be data on inflation itself that policy will react to. But going forward, policy will not tighten solely because the unemployment rate has fallen below any particular econometric estimate of its long-run natural level. This has important implications for the Taylor-type policy reaction function that I will consult. Consistent with our new framework, the relevant policy rule benchmark I will consult after the conditions for liftoff have been met is an inertial Taylor-type rule with a coefficient of 0 on the unemployment gap, a coefficient of 1.5 on the gap between inflation and the 2% target, and a neutral real policy rate equal to my SEP projection of long-run R star. Such a reference rule, which becomes relevant once the conditions for liftoff have been met, is similar to the forward-looking Taylor-type rule for optimal monetary policy derived in my work with Mark Gertler and Jordi Galli 20 years ago. In closing, I think of our new flexible average inflation targeting framework as a combination of temporary price level targeting at the ELB that reverts to flexible inflation targeting once the conditions to commence normalization have been met. In this sense, our new framework indeed represents an evolution, not a revolution. thank you very much, and I look forward to the panel discussion with Carolyn, Phil, and Tobias. Thank you.
Thank you, Richard. And I'll turn now to Philip Lane.
Okay, thank you, Caroline. And I think the IMF is going to put up my 2 slides. So if you go to the next slide. Okay, so I was very pleased to be asked to join this panel because it is indeed the case that probably the #1 factor we have to think about in the ECB's monetary policy review is indeed this circumstance where I think there's a high global consensus that the underlying real interest rate, the equilibrium real rate, or STAR, is a lot lower than it used to be. And then, like everywhere, but probably even more so in the euro area, we also have the situation of low inflation. So inflation that's been persistently below our aim for a number of years. So I think this topic, as the managing director laid out, is central really to a lot of what we would do. I mean, of course, many of the issues that Richard Clarendon just talked about will of course be covered in our own review. But I think we also have to reflect quite a bit on the recent history of the ECB. And so, if you like, we have maybe a more broad-ranging way to think about the strategy review, which, if you recall, is basically the first time in 18 years there's a review. So I've put up here the kind of matrix of topics we're looking at, where, if you like, the first row is maybe, what you might expect. What should be the definition of the inflation aim, the inflation objective? What are the issues in measuring inflation? How do we think about how to stabilize inflation expectations at the target, and how should we communicate? So all of that would be common to any monetary policy review. But given it's 18 years since the last one, we also have to think about structural change in the euro area. So that's both structural change in terms of how the economy is behaving, but also, if you like, the kind of transmission mechanism, the institutional setting for monetary policy. So, of course, the review is in part, there's a work stream on Eurosystem modelling. What kind of models are they, what we need in order to analyse and forecast the economy. Very related to the topic of this evening and Tobias's work is the intersections between monetary policy, macroprudential policy, and financial stability, which, of course, this year with the pandemic, that's one type of financial stability risk we also have to encounter when you have to stabilize the financial system, as we all had to do it in the spring of this year. But of course, there's also maybe some ex-ante considerations there. But of course, what we know with the ex-ante considerations, I think it's a fairly universal lesson in the literature, is the more you can rely on macro-pru, the more monetary policy can be dedicated to meeting the inflation target and meeting other objectives, including, of course, employment and so on. Let me also emphasize in the bottom row is we also think about, the other elements in terms of the architecture of the euro area is the rise of non-banks. We have a different banking system now than 15 years ago because of the SSM, the increase in the capital ratios and so on. But we also definitely have the rise of non-banks. And so in terms of the transmission mechanism of monetary policy, we have to think about that. And we, like everywhere, do have this fiscal and monetary interaction issue. But of course, that comes with more dimensions in a monetary union when we have one central bank and 19 sovereigns, and then the supranational fiscal policy that's carried out this year more than ever through EU-level initiatives. And then the bottom row basically is a reminder that the underlying economy is also going through slow-moving structural change, whether it's globalization, digitalization, climate change, other drivers of innovation and technical progress. Now, these are forces that may shape the economy and in turn may also sometimes create shocks to the inflation process. So, of course, for monetary policy, in order to deliver the inflation aim, you'd want to be on top of all of these in order to make sure policy is directed correctly. So maybe if you go to the next slide. So what I'm not expecting to look too closely at this, but what I did want to mention, and again, taking into account the global audience of the IMF, is this shows you, this is a report from the European Systemic Risk Board, basically the extent of macroprudential measures in the European Union. And the top rows of this table, you can consult when you get a chance, but those are all the types of capital ratio measures. So in other words, there's more capital in the banking system from those various measures. But let me emphasize, in the middle there, all of those blue rectangles represent borrower-based measures. So restrictions on debt service to income ratios, restrictions on loan to value, loan to income, and so on. So we now have a financial system. We now have a kind of how the debt dynamics operate in the euro area, where there's quite a lot of restrictions compared to what we had before. And at the very least, in terms of structural change, how monetary policy works today is going to be quite different to how it worked pre the financial crisis, when we do know some of the deep concerns we all carry around now about how loose credit conditions can convert into excessive risk-taking. The big question is how much of that is now contained through all of these measures, and how much remains to be something to keep an eye on in the monetary policy process. So maybe I'll just stop there, that essentially I would share there's a high degree of commonality across all the central banks. All of the issues that Richard talked about, we would share. But on top of that, there's also the basic issue of understanding the dynamic of the economy and understanding the monetary transmission mechanism. So those are really a large part of what we're doing in this particular monetary policy review. So let me stop there.
Thank you very much, Philip. And the work that you're doing is so comprehensive, covering not just the frameworks, but the environment in which those frameworks are going to have to operate. And that's going to be extremely valuable for you in your area, but also for other central banks. So with that, I'll turn to Tobias.
I'm very happy to be part of this panel and would like to thank our virtual audience for attending. In their remarks, Richard and Philip have already shared some deep insights on monetary policy. I would like to build on the analysis by considering implications of more accommodative monetary policy for medium-term financial stability risks. As you all know, the challenges associated with COVID-19 have called for exceptional policy responses. The combined scale of interventions was truly staggering. Unconventional monetary policy operations amounted to $7.5 trillion globally, based on our estimates here at the IMF. In my view, the importance of central banks exercising their implicit put option cannot be overstated and has been a game changer in helping to stabilize financial markets. And given the severity of the COVID shock, substantial policy accommodation will be needed going forward for central banks to achieve their policy objectives. At the same time, and as we have emphasized in the October Global Financial Stability Report, these policies are effective because they encourage risk-taking. As such, these central bank interventions may also increase medium-term and long-run macro-financial vulnerabilities. The same consideration applies to changes in policy frameworks, given that they also aim to provide more stimulus in an environment of already very low interest rates. I believe that existing policy models are ill-suited to quantify and help manage the resulting macro-financial risks. My recent MCM departmental paper puts forward a parsimonious framework which addresses this issue. it places financial stability considerations right back at the heart of monetary policy making. We call the model NKV because it is a new Keynesian model in flavor, but also accounts for financial vulnerabilities. The NKV model is designed to account for the interplay of financial conditions with real economic variables. In particular, the model captures a key intertemporal trade-off documented empirically, including in my 2018 paper with Greenberg, Lang, and Malik. That paper used data for both advanced and emerging market economies to show that looser financial conditions have favorable effects on output growth in the near term, boosting output growth significantly and reducing downside risks. However, looser financial conditions also increase risks that output growth will be weak a couple of years down the road. Hence, there's a trade-off. The chart that you can see here uses the NKV model to analyze lower for longer type policies in which the central bank credibly commits to providing monetary stimulus for extended periods of time that range between 1 and 3 years and may be interpreted as forward guidance about the policy rate path. The panels help to make 2 points. First, they confirm that lower for longer policies are effective at providing short-term stimulus, as seen by the response of output on inflation in the upper panels. Arguably, this is one of the reasons why central bank interventions play such a large role in mitigating the adverse impact of the pandemic. Second, as seen in the lower right panel, these policies can have a marked impact on the evolution of financial conditions. While a accommodative policy loosens financial conditions in the near term, these policies can be associated with a significant tightening of financial conditions in the medium term, with potentially adverse implications for real activity. This highlights the intertemporal trade-off that policymakers are faced with when easing monetary policy. As highlighted by the fund in an important 2015 board paper, macroprudential policies can, at least in theory, help mitigate financial stability risks. Our NKV-based model results confirm these observations. As seen in the slide, the introduction of macroprudential policies can moderate swings in financial conditions, mitigating unintended side effects of lower for longer type policies. But there are many important differences between theory and practice. On account of those differences, macroprudential policies are not a universal panacea, and there are many cracks that have difficulties getting into by prudential policies. For example, risks related to non-bank financial intermediaries are an important example. Macroprudential policies may be difficult to deploy due to political considerations, or even if deployed, may be less effective in the short run due to sizable lags in transmission. I believe that most existing monetary policy models fail to account for this key intertemporal trade-off that I've highlighted, in which a contemporaneous boost to activity eventually increases microfinancial vulnerabilities. And if one considers monetary stimulus as a free lunch, then we know that there may be a tendency to overindulge with potentially dire medium-term and long-run consequences. Macrofinancial risks can, and in my view, should be the core of monetary policy making. My framework helps to quantify the intertemporal trade-offs that monetary policymakers face, as well as how macroprudential policy may influence these trade-offs. Arguably, underlying endogenous risk considerations are even more relevant in an open economy. This is because swings in global financial conditions can bring about sudden stops or capital flow reversals. As you know, Efforts to quantify such trade-offs and to analyze synergies associated with various policy mixes are at the heart of the IMF's push to develop an integrated policy framework, which was launched earlier this year by the Managing Director, Georgieva. Going forward, I want to underscore that continued monetary accommodation seems crucial in supporting economic activity and helping central banks achieving their objectives. But central banks will also need to be vigilant to the risks that are attendant on highly accommodative monetary policies and should take account of these intertemporal trade-offs as a key part of decision-making. I look forward to the discussions on these challenging and related issues with the panel members. Thank you for your attention.
Well, thank you very much, Tobias. And I have to say that those intertemporal trade-offs are so important to make, and at the same time, from a policy point of view, they're difficult to gauge. So your research in this direction is really helpful, as is the IMF's comments that they also often make about just how important it is to have the right governance in place between monetary policy and macroprudential policies to allow those trade-offs to be made effectively. I'd like to just turn the first question to Richard, and I found your presentation extremely enlightening about your new framework, and I know that you finally settled on a particular one, but you did take a serious look at different frameworks for monetary policy that were consistent with your mandate for price stability and maximum employment. And many of those are the same as the ones that are in our own horse race at the Bank of Canada. And so, as you said, on the price stability side, the FOMC ultimately chose an inflation targeting framework that will be implemented as a conditional tool. And that's one that only applies when the zero lower bound binds and inflation's persistently below target. And so what I'd like to dig down a bit on with you is what led you to choose that particular form of average inflation targeting that has an asymmetry as one of its defining features, rather than a symmetrical approach. And then kind of commensurate with that, it comes with a sort of an ex-ante aspiration, as you've put it before, rather than an ex-post commitment to average inflation at 2%.
Well, thank you, Carolyn. That's a great question. I should also say that in our review, we benefited enormously from the stellar example that the Bank of Canada has set now over 3 decades, and I benefited very much in the conversations you and I had with other members of the Bank of Canada. So we were very much building on your decades of work in doing these reviews. But getting back to your particular question, I think the short answer to what is a very complex question is we settled on an asymmetric framework because the problem caused by the ELB is asymmetric. That is, the ELB constrains central banks' abilities to offset adverse demand shocks, but not positive demand shocks. And the way I like to think about it is that if you're really, really successful and you're always able to offset excessive demand shocks, but you're constrained in offsetting adverse demand shocks, then what that means is that success under inflation targeting is going to result in a downward bias to realized inflation and inflation expectations. And so the asymmetry really flows naturally from the problem that you're trying to solve in a low R-star world. You know, in the most recent pandemic, our policy rate peaked at about 2.4%, and we had made some adjustments in 2019, so we were able to cut by 150. And on March 15th, we were already at the lower bound. So the remedy is asymmetric. It really entails, as I said in my remarks, a couple of simple principles. First, delay liftoff until actual inflation equals or moderately exceeds 2%, and then normalize policy gradually to bring inflation back to 2%. And at least as I indicated in my case, the pace at which I would want to do that would be a function of inflation expectations on average inflation. And then finally, why not go for a fully symmetric and potentially easier to diagram approach? It has two problems. One, it doesn't solve the ELB problem. And secondly, we came to believe it would not be time consistent to promise to undershoot inflation intentionally after getting above it. So that's the crisp answer to your important question.
Well, and that makes sense, and it really highlights the point that the managing director made at the beginning about how important it is to develop our extended toolkit, the tools that we use that aren't just moving up and down the interest rate. And so the work that you're doing in that, and the exploration you're doing in that regard is so important. I'll turn to Phil now, and you've laid out a very expansive review of your monetary policy framework. And as I said, it's going to be very helpful for all of us. One of the main drivers for all of our reviews is the world that we live in, where central banks not only are constrained by the effective lower bound, but they're more likely to hit it, given where our star is, where the neutral rate of interest is. And of course, that means we need to move to our extended toolkit. I try to avoid calling it the unconventional toolkit because it feels pretty conventional these days. And another driver is that not only that, we've had a number of economies that are experiencing low inflation, and I'd really love to get your view. I know your review's not complete, but I'd love to get your view on what you think the main drivers are of, or have been, of low inflation in Europe, and what can be done about it. And are there any differences you see between Europe and other jurisdictions that might lead central banks to prefer somewhat different monetary policy frameworks?
Okay, so you packed a lot into that question.
I did.
Let me go in reverse order. I'm not so sure. I mean, in the end, we know a lot of time there's a divine coincidence between what's needed for inflation and what makes sense in terms of increasing employment. So in a world where the divine coincidence applies most of the time, and in a world where the ECB has always made clear its inflation aim is a medium-term concept, and that's always been motivated by the fact you really don't want to tighten too quickly in response to an adverse supply shock because of the employment consequences, is that I do think when you drill down into it, yes, it probably makes a big difference in communication, but in terms of how we operate, I'm not so sure the different mandates. There will be, I'm sure, scenarios where it does matter, but for the context where we're in of below target inflation and so on, I'm not so sure right now it matters too much because, very much the same factors that are needed to drive up inflation will also be very good for employment. And by the way, I mean, even though this is our kind of first review in 18 years, we've clearly moved quite a bit in terms of how we actually make policy. So the adoption of conventional, unconventional measures from 2014 onwards, the emphasis we've put into forward guidance. So already, these are issues about it's so hard to forecast inflation. You really want inflation to have picked up quite a bit before you get to the liftoff. We already have that in our forward guidance where we say not only the policy rate will not be raised, but also QE will only come to a stop, net purchases shortly before that. So, and that's conditioned not just on the inflation projection, but underlying inflation to already have picked up. So a lot of that has the same spirit of a lot of what the Fed is saying. So then when you look back, I mean, it is definitely the retrospect, the stock take is so important in these reviews. And let me give you some elements of how we would think and some of the published work of the ECB. When we had 20 years of the euro 18 months ago, there's been some papers written around then, and the paper by Massimo Rostagno and his colleagues, I think, is maybe the best indicator. And if you think about the narrative of low inflation, it is the case that we not only had the global financial crisis, we had our own European sovereign debt crisis after that. So we had maybe 5 years from 2008 to 2013 of crisis conditions, which is not very good for the inflation dynamic. And of course, because of the fact in the European context has a unique history in terms of fiscal policy, is in the recovery from that, we had fairly tight fiscal policy as the emphasis was to rebuild fiscal space. So the very sharp contrast between the US and the euro area in terms of fiscal dynamics in that situation, which of course is very much changed this year. So, and you might also look as another indicator of the gap between the economy and overall demand conditions, this very persistent current account surplus for the last decade. So, if you like, I put a heavy emphasis on the traditional, interpretation of just lots of slack in the European economy. Like the US, before the pandemic, the labor market had tightened. We saw some non-linear recovery in the wage Phillips curve, if you like. And if you like, the remaining step was more recovery in pricing power. So I think there's that. Of course, all central banks, these features of globalization, digitalization, and so those are global, they're common. They were going on for many years before this low inflation episode. They do play a role, and this is why we do think understanding the economic model, understanding the structure is so important. But in the end, with the correct and sufficient monetary policy response, any anti-inflationary pressure from those shocks can be offset. They can be neutralized. And then maybe behind all of that, the lesson, if you spend a good number of years with inflation too low, you do have the challenge of rebuilding inflation expectations. And that's very common to all of our situations, is how do you anchor inflation expectations or re-anchor back at the target when the near-term data is below target?
That's really interesting. And when you look at the point you made about the dual mandate and how much of a difference does it make relative to a single mandate on inflation, and our research work shows that it actually doesn't make that much of a difference if you already put a weight on deviations from full employment. And so I think that's one interesting point. And certainly for all of us, when we look back and say, how did we make the misses on inflation on the downside? In our case, it wasn't so much the lack of weight on the output gap. It was more a question of being overly optimistic on our forecasts for GDP growth, particularly for the US, that's obviously spilled in the misses for Canada. So I think that work is very important. So Toby, we've been talking about individual countries, and the IMF just makes an excellent contribution in its discussions of monetary policy regimes, because you take a global perspective and you think about how these affect the global monetary system and in part also have spillovers to other countries. And so when you listen to all this, what do you think the implications are of the evolving policy frameworks, such as average inflation targeting for the global economy? I mean, when you think about more accommodative monetary policies right now, seem desirable, particularly when most of the global economy is in recession. You were also thinking about how they might cause problems down the road and how they might even affect a foreign exchange market. So could you tell us a little bit about your thinking there?
Yeah, absolutely. Thanks, Caroline, for this question. So the new frameworks, such as the average inflation targeting that Richard explained, or the kind of thinking about getting back to the inflation target that Philip explained, those are really frameworks that aim at having additional abilities to ease monetary policy in the face of the effective lower bound, where conventional tools are limited. And so this is extremely welcome and extremely important because we think that we might be in a prolonged period of time where advanced economies are facing those effective lower bounds. Of course, the new frameworks such as average inflation targeting are also expected to be complemented by further asset purchase programs, which have proven to be very effective. This COVID crisis in 2020 really illustrates how important the positive spillovers from advanced economies to the emerging markets in the face of a common adverse shock are. What you had was the pandemic hit every country in the world and had dire economic consequences. And the very timely, decisive, and aggressive monetary easing in advanced economies had tremendously beneficial impacts on emerging markets. So while in March we saw big capital outflows out of emerging markets, with the monetary easing, financial conditions eased, and there was an access to global capital markets that was restored very quickly for emerging markets. That is a tremendously beneficial effect. And so there are really two transmission channels that we can think about. One is through real economic activity. Of course, when advanced economy come back to life, that has positive spillovers through trade channels. And even if easing monetary policy might have an adverse impact on the value of the exchange rate, the trade channel is likely to dominate in terms of a positive spillover. And then there's the financial channel, which is the impact on easing global financial conditions. And when you look at this year, it's really a tremendous success how well the central banks managed to ease global financial conditions to allow even riskier borrowers to have access to markets. I heard just this morning that some of the most risky countries are either thinking of coming back to markets or are coming back to markets. And those are very beneficial spillovers. But of course, as time goes on, there could be also risk-taking that could be excessive. And so for emerging markets, just as for advanced economies, it is very important to keep a watch on financial vulnerabilities and to make sure that prudential and regulatory tools are deployed appropriately.
It's interesting. You make a lot of excellent points about emerging markets, and I think about just the global financial conditions and how important they are to drive Canadian financial conditions as a small open economy. And so I wouldn't say that Canada shares all those attributes, but certainly supporting global financial conditions is a very important part of our own monetary conditions in Canada. So if I go back to you, Richard, part of what's on my mind with respect to your new framework and all the frameworks that we're going to choose is how can we communicate them? And part of the ability to communicate is related to the clarity of the objectives themselves, and you were very clear about what they are. But it's also with respect to their simplicity. And I know you've contributed to a very influential literature that made the case that simplicity was quite an important feature. And so I have no doubt that your colleagues have thought about some of the challenges that might be implied or because of your new framework, and you have a plan to address those. But I was hoping you could share with us some of the main elements of the Fed's strategy, the challenges of a more complex framework, and are there any aspects of your communications that you've changed already?
Well, thank you. That is an excellent question, and Carolyn, we were very cognizant throughout the process. The Fed in 2012 was the last major central bank in the world to adopt flexible inflation targeting. And as we worked through the review and we realized the direction we were heading, we certainly realized that we were breaking some new ground here. We think of it as an evolution, but it's a robust evolution, and we think it's called for given the nature of low R star, the ELB, and the like. So we've worked very hard. I'm sure we can work harder, but we've worked very hard at tailoring our communication to make it as simple as possible. And I think, it won't surprise you to hear, I think we've succeeded. In particular, I think our outcome-based guidance that we issued in September and we reaffirmed in November, and our focus on employment shortfalls actually simplifies communication of the reaction function. So for example, what we're saying is that liftoff is only going to occur once actual inflation gets to 2%, and once employment indicators that we regularly publish and discuss are in a range that are broadly consistent with full employment. And so the reaction function in terms of the pace at which you, or the thought about lifting off is now more explicit than the Fed has ever been. Now once these conditions are met, we've also said that because we're only lifting off once in our judgment we're in the vicinity of full employment, then we're really only going to be focusing on inflation and data on inflation to dictate the pace of policy normalization once we return to target. Now, I'm always very careful, and even more careful than I was as a professor. The world is more complex than the FERBUS model or even the IMF's model. But what I can say is that if the world did look like FERBUS, then a very sensible policy rule post-liftoff would essentially be a Taylor-type rule with a standard coefficient on the inflation gap, but with a zero coefficient on the unemployment gap, reflecting both the flatness of the Phillips curve and the uncertainty about R star. And basically, you just zero that out, and you're just basically targeting inflation based upon inflation itself. And those rules have been widely studied, including with Mark and Jordy and in other work. So I agree that we're in a more complex world, but we're making an effort, I hope a successful effort, to simplify what it means in terms of our reaction function.
It's very visible that the Fed has done a lot of work, not only to communicate your actions, but also to reach out through your Fed listens, and we've certainly at the Bank of Canada taken some of your ideas on in terms of our own evolution in communications on the outreach side. Now, complexity is a big deal. You're absolutely right, Richard. It's not just the communications that's complex; it's the situation that's complex. And we've not only been deploying expansive and different tools, we're also having to think about those intertemporal trade-offs between our immediate monetary policy, economic stabilization goals, and then this intertemporal trade-off that can come to light because of financial vulnerabilities that build up. And I know, Philip, you've spoken in your intro, but also many other times about the risks of low for long, and it's also part of the mix of policies, fiscal, monetary policy, macroprudential as part of a review. How do you see the different policies working together to increase the effectiveness on the macro and price stability side, while at the same time, and we're asking a lot, restraining the buildup of financial vulnerabilities? And I think this is both an economic question and a political question, because there is an issue of central bank independence that comes to bear when we think about the mix of all these policies, particularly fiscal and monetary policy.
Sure, and of course, all of that has its own different flavors in a monetary union with 19 sovereigns. But of course, those 19 sovereigns, through the European Council, the European Commission, Eurogroup, European Systemic Risk Board, there are ways for the 19 sovereigns also to cohere. So let me, for example, come back to understand, the sources of financial risk in the euro area. And of course, as I mentioned earlier on, we did have our own sovereign debt crisis, which is unique to the euro area in 2010, 2012. So, the circumstances here are quite different. But maybe in some ways, it does change the specific challenge. I mean, what Tobias has done with his model, I quite like. It provides a lot of generality, but when you bring it to the particular context of the euro area, for example, look at what happened this year. Even though, of course, there's a huge challenge for many corporates, huge increase in public debt, and of course, yes, the central bank has been active in QE and so on. But if you talk to investors, a lot, and if the credit rating agencies have also made this point, there's essentially a net assessment that a lot of risk in the euro area has gone down because the way Europe has responded to this pandemic has shown that some of the questions about the euro area architecture have been answered. So in response to this large shock, the fact that we now have, as part of the fiscal response, the common funding of next generation EU, we also have the sure bonds and so on, does show that there's a sharing of tail risk, which I think is quite important. We've seen, so I do think sometimes, of course, there are the intertemporal trade-off issue, but oftentimes, what is good for makes sense from a monetary policy point of view is also good for financial stability. So there's a lot of circumstances, including right now, which is basically they're lined up. So I mean, there are conditions under which that intertemporal trade-off is more to the forefront. There's going to be cross-country variation. I can see it right now in different countries, but there'll be also, if you like, across different time periods, across different situations. So coming back, I'm a lot. We did so much was put into developing macro-pru. Yes, it's not complete. Yes, it's not everywhere, but a lot has been put in place. There's been a lot has been put in place in terms of improving the basic stability of the European banking system. So a lot of the concerns we had 10 or 12 years ago are less prominent today. You never turn off the worry, but I do think some of those conditions, are maybe right now less salient than they might have been in some other periods. So I would say we always, because we just published our financial stability review today. I think you can see all the work the ECB does on financial stability. We always keep a close eye. But I think we also have to remember the kind of, this has been the context when you're at quite low inflation rates like we are. The primacy of returning inflation to the target, the primacy of stabilizing inflation expectations, have a very high weight. The trade-off between monetary policy and preserving medium-term financial stability will probably depend on the distance you are from the target. So I think there's a state-dependent element in addition to the other considerations.
It's a complex issue, and I'm glad that you mentioned the tool that Tobias and his colleague, I believe Nelly and maybe others did to build the GDP at risk, because there's a lot of policy work behind there, but when you actually want to take the policy decisions, it's very nice to have a structured empirical framework that can guide out those decisions. And Tobias, you just published today a paper that does just that shows how accommodative monetary policy can fuel risk-taking and raises financial stability risk just down the road, and how macroprudential policy can help to contain these risks. And one of your concerns is that the monetary accommodation that's implicit in the new monetary frameworks in advanced economies might actually contribute to build up leverage in emerging markets and developing economies where there may be less of an ability to contain those vulnerabilities. And so in a very practical sense, how should policymakers aim to mitigate these global financial stability risks? And what sort of international cooperation might be needed to do that?
Yeah, thank you. So I think my basic argument is that the easiness of financial conditions and the degree of risk taking are part of the transmission channel of monetary policy, and it can cut both ways. So it can certainly be the case that there's too little risk-taking. And I think this is where the framework that I proposed would argue for aggressive policies, just as we have seen in 2020 when monetary policy was eased, in order to get risk-taking back and to ease financial conditions. And it really remains a question where we are in different countries. I think in some countries, the monetary and financial stability objectives are well aligned, while in other countries they might be in conflict. So, and this changes over time. What I'm arguing is that you want to keep track of where you are in terms of whether these incentives are aligned or whether they are in conflict. And so this is where the framework can help. And so for emerging markets, we have done much work to show that macroprudential tools are indeed quite helpful in terms of mitigating the buildup of vulnerabilities. But of course, it also works in the reverse. Tools can be eased. And we have seen quite a bit of that, again, in this COVID crisis this year, where there was too little risk-taking so that you wanted to ease macroprudential policy. And our evidence is that this is extremely useful and extremely helpful. And ideally, you would be at a place where monetary policy can basically ignore what's happening in the financial sphere because macroprudential policy is taking care of all those stability risks. But of course, in practice, this pure separation is difficult to achieve. And again, in the non-bank sector in particular, we don't have quite as many tools as in the banking sector. And so there can be a wedge in between what you want to achieve and where you are in terms of either excessive or too little risk-taking. I would add to that cooperation and coordination among central banks is extremely important. So we have seen that swap lines from advanced economies to emerging markets have been tremendously helpful in terms of easing funding pressures in emerging markets. And of course, the IMF is also there to help the membership around the world. We have distributed financing to over 80 countries since the start of the COVID crisis. And we have created a new short-term liquidity facility to help our membership to withstand adverse shocks to financial conditions globally.
It really has been all hands on deck, I can tell you, with the G20 and the G7 meetings. It's a good thing that we're working to maintain those relationships. I have one last question for each of you, and if you could just give a really short answer to it, we'll have the time. And it's really, if there's one thing about this COVID experience that's really informed how you're thinking about the monetary policy frameworks, what would it be? And I'll start with you.
Well, thank you, Carolyn. I guess, we announced our framework review in November of 2018, and it was largely completed pre-COVID. Indeed, we were planning in February to roll it out in the spring. We paused the review, but then we took it up again in July. And at our meeting, we had a very wide-ranging discussion about whether or not it made sense to launch this new framework in a post-COVID situation. And there was unanimous agreement that we should. I would say, however, it would have been much easier to roll this out in February with an unemployment rate under 4 and inflation close to 2%. But that was not the hand that we were dealt. So that's the reflection I would have on that.
What about you, Philip? What's the one thing?
Sure. So again, we had started before the pandemic. I mean, I think coming out of the pandemic, the initial conditions will be different. As Rich says, probably the economy is going to be weaker. And the kind of the financial system is going to be in a different state. We know there's going to be a lot more private sector debt, a lot more public debt. And so the work of the IMF is that probably will be even more relevant now in the sense of how to think about where we are in that risk-taking spectrum. And so that risk management issue will be super important. But of course, in a world where that legacy has been built up. Some of the kind of super bubbly conditions we had pre the financial crisis may be quite some distance away.
So yes.
Well, I think this COVID crisis has led to a temporary decline in output. And the hope is that once the vaccines are rolled out, that economic activity goes back to normal. However, we worry that there's scarring in the economy, that we don't get back all the way, at least not immediately, so that there might be output gaps that will last for some time. And the equilibrium rate of interest, the R star that was mentioned earlier, might be even lower than it was prior to the pandemic. So when you look at yield curves, you know, they're certainly lower for even longer after this pandemic. So in this context, the framework reviews are even more important, because it's even more important to be able to stimulate the economy and to get inflation back to target in the context where advanced economies might be at the effective lower bound for many, many years. In addition, we have even seen many emerging markets that are now either at or just above this effective lower bound. And indeed, many emerging markets have started to undertake asset purchase programs and to deploy forward guidance in order to stimulate. So my takeaway is that, you know, this pandemic, which hopefully will be temporary, might still have a persistent adverse impact on economic activity, on inflation, and so having powerful monetary policy tools is even more important in this recovery phase.
I think that's right. We just revised down Bank of Canada our estimate for the neutral rate of interest by 50 basis points, and we cut our estimate of potential output at least over the next few years in half because of those scarring effects and lower investment. And so getting us back to a stronger growth profile is just so important. I'm looking at the time, and I think it's time to wrap up. And so let me just first thank the Managing Director for her opening remarks. I fully agree with her that the central banks must continue to work hard to consider innovative new strategies in this low interest rate world. And I'd also like to thank the panelists, Richard, Philip, and Tobias. Your remarks were insightful, and they've given us a lot to think about as we seek to find the best monetary policy framework for the times that we're living in. There's many central banks, including the Bank of Canada, that began our work before COVID hit. And we already knew we had limitations to our firepower because of the effective lower bound. And we were concerned that inflation expectations were drifting down in this low inflation environment. And those were strong motivators to try to find ways to improve. And of course, financial stability issues with low for long were also motivators for some of us. And it's clear from our discussion that the experience with COVID, which is so tragic on both a human and on economic fronts, has only reinforced the importance of our efforts. Now we have a common goal, which is to spur sustainable global economic growth as we get out of the COVID situation, but also to lay a firmer foundation for achieving central bank goals in the coming decades. Of course, there are many important questions that can only be addressed through further analysis and experience, and some questions will undoubtedly center on the use of quantitative easing and other monetary policy tools, their efficacy, their unintended consequences, how they affect things that matter to people, including the distribution of income. Now, others are going to focus on how fiscal and monetary policies and macroprudential policies can complement each other while respecting central bank independence. That is going to be an important thing going forward. And I think the biggest challenge is going to be to effectively communicate our strategies, even if they are only an evolution of what we've done successfully for the past decades. Now, our goal here just can't be just to strengthen our policy effectiveness. It has to also be to build trust with the people that we serve. And I like the fact that all of our reviews have taken or are taking consultation with the public very seriously. Now, there are many aspects of the framework that cut across the borders, and so it's quite fitting that the IMF has sponsored this event, and I'd like to thank them for that, because countries can clearly learn from each other. But we heard today, changing the frameworks, especially by major central banks, may have substantial spillovers to other countries. And central banks and regulators have to also be attentive to containing financial stability risks that are often global in their nature, given that interest rates may be lower for longer. I think that's why the managing director said earlier that the stakes are high when it comes to identifying the right approaches and policy tools. And I'm confident that central banks around the world, along with the IMF, will continue to work together to face the challenges of a low interest rate world and set the foundation for renewed economic prosperity. So thank you very much, everyone, and I wish you well.
Thank you, Caroline.
Thank you. Good session.
Thank you so much.